Benjamin Graham is often called the father of value investing. He wrote two of the founding texts in Neoclassical Investing, Security Analysis, 1934, and The Intelligent Investor, 1949. Graham attended Columbia University before starting a career on Wall Street. He then founded the Graham-Newman Partnership and employed Warren Buffett. Warren Buffett benefited greatly from Graham's approaches and subsequently wrote the foreword for this book. Graham's investment philosophy was always based on investor psychology, minimal debt, buy and hold investing, concentrated diversification, and buying within the margin of safety. The Intelligent Investor is a book that aims to help people invest in the stock market while minimizing their economic risks. It focuses on longer-term and more risk-averse approaches. Graham focuses on investments based on research, rather than speculations based on predictions. The Intelligent Investor provides guidance on how to get involved in value investing and how you can prevent Mr. Market from dictating your financial decisions. Chapter number 1. The history of the stock market. Many new enterprising investors will use historical data to forecast the future, but the value of any investment is a function of the price you pay for it. Graham provides multiple examples of the most common reasons that people mistakenly extrapolate previous stock prices: buying into the hype of strong bull markets, not doing your own research, relying on experts who aren't necessarily experts, not staying humble when your stocks are performing well. Graham reminds us of the distinction between investment and speculation. The key distinction: an investment involves thorough analysis aimed at preserving principal and generating adequate returns. Not that Graham is entirely against speculating. He argues it can be fascinating and fun, while you are ahead of the game, and those who want to try it should invest only a small portion, the smaller, the better, of their portfolios, in separate funds. About defensive investors. Graham then spends some time discussing what returns an intelligent defensive investor might expect in the mid-1970s. When he published this final edition in 1973, both bonds and common stocks offered reasonable returns, and he reviews portfolio allocation in such an environment. He concludes a simple 50-50 split between bonds and stocks is a starting point. Beyond that, he believes that either one might represent between 25% and 50% of a portfolio. As to which stocks should go into a defensive investor's stock allocation, Graham says he has no particular favorites. He also does not expect stock selection by defensive investors to make a material difference, saying, "We are skeptical of the ability of defensive investors generally to get better than average results." Further, he notes he is also skeptical of the efforts of experts who manage large funds. Still, defensive investors should avoid new offerings and hot issues, the types of investments associated with quick profits. About aggressive investors. Graham now turns his attention to the aggressive investor, someone who expects to earn better results than defensive investors. The key for this group, he says, is in starting with a clear conception about the courses of action that could lead to success and those that would not. Three courses which are not likely to lead to success are trading in the market, short-term selectivity, and long-term selectivity. He defines short-term selectivity as buying stock when a favorable event is expected, such as an upcoming report with increased earnings. Long-term selectivity refers to companies that are expected to generate high earnings power at some time in the future. This includes drug, computer, and electronics companies developing new processes or products. Developing these points further, Graham warns aggressive investors about short-term and long-term opportunities by pointing to human fallibility and the nature of investing competition. Aggressive investor policies. Thus, Graham comes to this conclusion: to enjoy a reasonable chance for continued better than average results, the investor must follow policies which are 1. Inherently sound and promising, and 2. Not popular on Wall Street. What are such sound and promising policies? He gives us a few possibilities. Speculative stock movements: prices swing like a pendulum, and often swing too far in either direction. Stocks may be undervalued because the market's lack of interest or some irrational sentiment. The misadventures of other investors. We can go further and assert that in an astonishingly large proportion of the trading in common stocks, those engaged therein don't appear to know, in polite terms, one part of their anatomy from another. special situations, which may appear promising, but big problems may well lie in the shadows. These approaches are not binary, you can find a blend which suits your personality. In this chapter, Graham calls investing a unique kind of casino, one in which you will not lose in the end as long as you stick by the rules that put the odds in your favor. People who invest make money for themselves, people who speculate make money for their brokers.